Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss DraftKings, the leader in the online sports gambling industry, who has seen a major pullback of over 30% in their share price over the past few months. This company has exploded throughout the past year, growing in popularity as more and more states legalize online sports betting. But as of late, when the entire market has rotated out of growth companies and into value, DraftKings has seen a major pullback. And just this week, shares have fallen another 10% after Hindenburg unveils a short position against the company. The research firm alleges that DraftKings' technology unit, SB Tech, operates in companies where gambling is banned. Of course, DraftKings has denied these allegations, but once this report came out and they announced a short position, it had a major impact on the share price, and over the past week, the company is down by 10%. And we can see overall, from a high point back in the middle of March 2021, right around $72 per share, DraftKings has now fallen by 32%, back down to the $48 level. And as the company continues to fall, Cathie Wood and her team at ARK Invest have been buying more and more shares, building up DraftKings as a key position in a few of their ETFs. And now I'm going to share with you a short clip of the analysts on CNBC sharing their opinion on this news about DraftKings and the short position by Hindenburg.
Right? We had the Hindenburg report, and then we had another report that Cathie Wood
bought 900,000 shares.
$42 million worth.
How many divisions
Not
does Hindenburg
insignificant.
have? You know, with Hindenburg, this is, I think, I mean, look, again, I work for DraftKings. I think Jason Robinson runs an outfit where he literally could take this one division and just sell it to somebody for $1, and then Hindenburg, this ST division, and then Hindenburg would have to say, you know what, no harm, no foul, stock goes higher. All Jason has to do is get rid of that one division, which he could. He doesn't need it. It's 8% of the revenue.
But let's just.
So we can clearly see that Jim Cramer does not believe these allegations are that big of a deal. The division in question only accounts for 8% of DraftKings' total revenue, and the company's leadership can just offload that specific division, get rid of all the negative turmoil and the allegations, and continue to operate and grow like they have been doing. And later on in the interview, Cramer said this about the future of DraftKings.
I think that what matters with DraftKings is gambling, whether more people will gamble, and whether they have a low cost of acquisition. That's what matters. Not this division that they can get rid of tomorrow. So Cathie Wood, I think, ultimately is going to be right. If you have an NFL season where more people want to gamble, do you think we're going to remember this little division that's 8% of their business? No. Legal gambling is one of the most important trends in the country because every state is bankrupt.
So once again, we can see that Cramer clearly points out that the short-term allegations against a minor division of the company will not slow down their long-term growth, and he actually believes Cathie Wood is right by loading up on shares at a discounted price. And we can see that Cathie Wood has been buying into DraftKings over the past few months, and the yellow line on this chart indicates DraftKings share price. The purple shows how many shares of the company is owned by ARK Invest. So as the yellow line has been decreasing, we have seen an acceleration in the shares purchased by the ETF manager. And we can see over the past few days, as the new short seller report came out, a major spike in total shares, up to over 12.1 million in total, and this company is now in the top 20 largest holdings under the entire ARK Invest umbrella. So it's becoming a major player under this asset manager, and we can see throughout late May and early June, the company continues to buy more and more shares of DraftKings. So if we jump over to the stock chart, they trade under ticker DKNG and currently sit around $48 to $49 per share, and on the 1-year chart, they are up by 16%. But like we saw over the shorter term, they have fallen 32% from their high, and I personally believe DraftKings is now trading at a very attractive level. The company has a market cap just above $20 billion, and they're the leader in an industry only poised to see major expansion over the next few years. A recent article shows that the revenue generated from sports betting is forecasted to skyrocket as more states approve the action. Right now, 31 states have legalized single-game sports betting, which represents only 56% of the U.S. population. And 9 other states have the betting bills pending, currently in the works. And overall, as more of these states that already have the single sports games legal and they transition that legality online, DraftKings is going to have a greater potential market to obtain more customers and grow their revenue year after year after year. And like we heard from Cramer, online sports betting is a trend that's here to stay. I personally believe that over the next decade, pretty much every state will legalize the action and DraftKings' total addressable market will explode going forward. And if we take a look, over the first quarter of 2021, even though the company has seen some decline in share price, their revenue numbers have been phenomenal. Their year-over-year revenue growth was 171%, which is absolutely incredible. And over the past quarter, the company continues to launch new products, and they did no share dilution over the past 90 days, and they don't plan on doing it until the stock hits $135 per share, which means DraftKings would have to more than double their current size before we see any further share dilution. And currently, this company is already a leader in their industry that only serves 27% of the US population. So although right now, single game sports betting is legal to a lot more people in the United States, doing it online is only legal right now to around 27%. And for online iGaming, currently that sits at only 11% of the US population as well. So a very small market actually has access to these legal activities at this current point in time. And of the 27 and 11%, currently DraftKings is live to 25% of the US population and 10% for online iGaming. So currently we can see of the potential addressable market, DraftKings is already attacking most of them at this current point in time, which is a great sign. And going forward, if you take a top level perspective on DraftKings right now, the company is down 32% from their highest point, which is a major pullback for any company on the market. And take into consideration that only 25% of the US population has access to their services. Imagine when the entire country can use DraftKings. Imagine when the entire country, including Canada and Mexico, have access to DraftKings services. Imagine where the revenue will go over the next 5 to 10 years if everything goes right for the company, they continue to operate and remain leadership in this fast-growing sector. If you're a bull on iCasino games and online sports betting, and you believe the industry is going to flourish like many analysts believe, definitely do some research into DraftKings right now. Speak to a qualified professional because there are some associated risks with getting into a company right now before they're profitable, and take a look at the potential growth of this brand over the long term. Remember, I'm not a financial advisor, we're just taking a look at their investor presentation, but the absolute potential here, I think, is very strong in my personal opinion only. And taking a look, the company is already a leader and they're live in 12 states. Meanwhile, all their competitors are operating in 11 or less. So it shows that this company can get in and produce activities in as many states as possible at the current point in time. And taking a look, currently 30% of the gross market revenue, that means the entire industry of online sports betting, DraftKings generates. 30% of the entire revenue in the fourth quarter of 2020 for the entire industry for online sports betting came through DraftKings, which is absolutely remarkable. And in the iGaming sector, they represented 19% of their total revenue, so pretty much 20 cents of every dollar in revenue was flowing through DraftKings for the online casino and iGaming industry. So again, this company has shown their dominance, they're operational in the most states, and right now, with a small percentage of the US population, maintaining 30 and 20% respective market share is absolutely incredible, especially when they're operating in an industry that does have a lot of big competitors. And if we take a look at their financial statements, we can see year after year, the company's total revenue has continued to grow. $226 million, then $323, $614, and in the trailing 12 months, they've generated $838 million of total revenue, which is a great sign. Of course, they are not profitable just yet, and they have posted a net loss of $1.5 billion over the trailing 12 months. But for a company like this, seeing consecutive net losses is nothing too shocking, and over the next few years, as their market base continues to grow, I do think the company's margins will improve and they will achieve profitability over, I'm going to estimate, 5 to 6 years in the future. And of course, when you buy into a company like DraftKings, remember you are taking on more risks because the company is pre-profits. And now we're going to take a look at their balance sheet where we can see they have $2.8 billion of cash on hand and total current assets of around $3.2 billion. And compared to their short-term debt that currently sits at $638 million, over the shorter term, a current ratio well above 4 and very safe and sustainable for DraftKings at this current level. And overall, the company has $1.2 billion of long-term debt and total liabilities of $2.16 billion. So of course the company is burning through cash year after year, so they do have to maintain a high cash level in order to fund their growth, but I do feel comfortable over the shorter term that their $2.8 billion of cash on hand will do very well to maintain all the liabilities on the balance sheet, which is a strong sign. And if we take a look going forward, analysts do believe their revenue will see some exponential growth, and over the next year, they're forecasting 89% revenue expansion to $1.16 billion, and then in the following year to grow to $1.62 billion. And going forward, taking a look at the next 5 years forward, the average expectation per year is 30% expansion in DraftKings share price, which would be absolutely remarkable. And the company overall currently sits below the 12-month expectation that is set at $70.63, representing a ton of upside from their current $48 position, and the stock is considered a buy, coming in at a 2.1. So overall, it looks like analysts do like this company over a shorter term and long-term perspective. I do believe DraftKings will grow. I don't own the company just yet. I am thinking about starting a position in my smaller growth portfolio because I do believe in this company long term. Although I don't own them, I've actually never used their service. I'm not a gambler. I just think the business, the fast growing industry, and the current fact that they're the market leader, I do think over the next few years, DraftKings will be worth more than $20 billion. I don't know if it's going to go to $100 billion. I don't know if it's going to be the next $1 trillion company, but I do think going forward, in my personal opinion only, my own guess and my own forecast for the future, not financial advice, I can see DraftKings being worth $40, $50, $60 billion over the next 3 to 5 years going forward. So I think right now the major decline in share price for an investor who's willing to do the research into this company and take on the risk may be a nice opportunity to get in at a nice discount. And like we saw from Jim Cramer, he's not too worried about the short-term allegations from Hindenburg. He believes the actual research firm, because it only makes up 8% of the company's total revenue, can just be offloaded or disconnected, and it will not impact the long-term growth or success of the company as a whole. And clearly Cathie Wood feels the same way, or she would not be loading up on shares like we've seen her do over the past few days. So overall, that was a quick analysis on DraftKings. We took a look at the major allegations in the short position from Hindenburg. Cathie Wood has been buying the dip, and we took a look at to see what Jim Cramer and CNBC analysts have to say on the stock right now. And of course, we went through their latest investor presentation. So let me know down in the comments what you think about DraftKings, if you think these allegations are real and the stock will fall further, or if now is an excellent opportunity to buy the dip. I love having discussions down below, so please hit that like button, subscribe, and join the channel, and I will see you in tomorrow's video.